What is up? In this video, I'm going to be talking about what you are probably most likely going to be doing wrong as a new or just as an ICT trader. Now, this is going to be a very simple video explaining how you can probably improve your day trading skills just by understanding some simple things about ICT and how he trades. So, the first thing is understanding the difference between a bullish and a bearish fair value gap. Now, if you are unsure about what a fair value gap is in the first place, then all a fair value gap is a three candle formation where the first and the third candle do not touch or connect or overlap in any way. So I'll use live example charts only just to show you guys. So as you can see, here we have three candles. So starting off with this blue one that my mouse is over. Let me just draw a line it. So this blue one right here, then this blue one right here, and then this wick of a bearish candle. As you can see, if we count from this first one through the second candle and connect it to the third candle, as you can see, the first candle and the third candle do not touch at all. Therefore, this is a bullish fair value gap. Now, as well as it being a bullish fair value gap, what this means is once price action goes into this fair value gap, you do not enter into any short positions. If you are using a bullish fair value gap, you want to use it as for long positions. So let's say price came back into this fair value gap right here, you would only enter longs off this fair value gap. Now, if you are a more experienced trader, you could start using inversion fair value gaps, but I'm not going to talk about this in this video. I'm just going to be talking about the just basics of a fair value gap and liquidity. So, if you were to trade this bullish fair value gap, you should only be taking longs off of this fair value gap. If price action taps into this fair value gap, you should not enter a short position because it came into a bullish fair value gap, okay? You should only be taking longs off this bullish fair value gap. Now, that is the opposite with a bearish fair value gap. So let's go just to a higher time frame to find a nice bearish fair value gap. So as you can see here, we have a bearish fair value gap. So we count three candles, 1, 2, 3. As you can see, the first candle here, and then we go through the second candle and the third candle do not touch or connect in any way at all, okay? So this is your fair value gap. Let me just explain that again for you. So as you can see, this third candle here, right here, and then this third candle here, and then this first candle, do you see how their wicks and wicks or bodies don't connect? So from this point here, if we draw that across, from this point here, in this space here where the fair value gaps is created, this whole area here that I'm highlighting for you, this whole area is the fair value gap. Now, as well as this, you can drag this out as far as you want. When you're trading ICT concepts, fair value gaps traded through price action. Once a fair value gap has been tapped into, it doesn't make the fair value gap then invalid. But with these fair value gaps, what you are going to want to do is only take shorts using a bearish fair value gap, okay? If price action comes into this bearish fair value gap, you do not want to use it to take long positions, okay? I see a lot of ICT traders getting confused with that. Now, as well as that, you can't just trade every single fair value gap that you see, because it will just not work. You have to pick which fair value gaps you use and pick them wisely. For example, if you are familiar with the silver bullet trade, all the silver bullet trade is just a time frame from 10 a.m. to 11 a.m. where there is a specific trade that happens that ICT teaches. Now, let me just show you the trade that's happened earlier today that I'm sure a lot of ICT traders would have took and would have lost money on. So as you can see, we are solely taking buy side liquidity. Okay, so we've took buy side liquidity here. If you're unsure what liquidity is, it is just where buy stops and sell stops are resting in the market. Okay, so we have buy side liquidity here, and then it's been swept there. We also have buy side liquidity here. This hasn't been swept yet. So what I mean by it being swept is once price action comes up and takes the swing high, then that is called a sweep of liquidity. Okay, so as you can see, we swept buy side liquidity here, right here, but we have not swept any liquidity here to the sell side. We still have sell side liquidity here, and we still have sell side liquidity there. Now all sell side liquidity actually means is just where sell stops are resting in the market. So these lines just represent where other people's stop losses are in the market. Okay, so why am I showing you this? If we play at the price action, as you can see, what has price done on this 1 minute time frame? Price has took sell side liquidity here. This is called internal liquidity because this is just a smaller time frame liquidity. The main target of liquidity would be down here. Okay, so as well as this liquidity being taken here, we also create a big bearish fair value gap. Now, from what I just told you, you guys are probably thinking, okay, so we short this fair value gap. No, the reason why I'm showing you this is because this is a trade where you want to use different ICT concepts to be able to trade the best and make your win rate the highest. Okay, so because we have already took liquidity, because we've already took this sell side liquidity here, this is a low probability fair value gap. Yes, this fair value gap could still work, but because we have took this sell side liquidity and then come into the fair value gap, the fair value gap has a very lower chance of working. Okay, so all I'm trying to show you now is you have to add liquidity and fair value gaps together. Don't just be trading a fair value gap by itself without looking at the context. Let's say that this didn't sweep the liquidity, and just imagine the liquidity was down here. This bearish fair value gap would be a lot more valid. Okay, and then once you get better at trading and once you get more experienced, or if you just want to learn the strategy that I trade, it actually uses liquidity like this, and I use fair value gaps in a different way. So I trade something called inversion fair value gaps. So I know that there was so many ICT traders that shorted this fair value gap right here today. Literally thousands of ICT traders would have went short here, hoping that this was their take profit. Now, I can understand why they would have took a short here, because it's big displacement candle at 10 a.m, which is a perfect time to enter a trade like this. But just because we took this liquidity, I knew that this trade was not going to work. So what I did, I waited for this trade, this fair value gap, to be inversed. Now what I mean by that is to get a close above a bearish fair value gap and then actually use it to take me up to buy side liquidity. So that's the trade that I took today. Now if you want to learn more about that strategy, then I have a full course teaching this trading strategy. So if you do want to learn that strategy, just click the link in the description. But yeah, other than that, I hope this video helped you guys. I just wanted to point out how you use liquidity to not enter trades, because as an ICT trader, you need to be able to realize when to not enter into the market.